Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day. Tired of carrying around a charger for your phone and a bunch of your other devices? This might change in the not so distant future. That's because the Ministry of Consumer Affairs is evaluating the possibility of a common charger for most mobile devices. Let's find out how consumers and device makers will be affected if such a policy is implemented.
All your mobile device chargers are set to have the same charging cable soon. The government is setting up expert groups to look into the adoption of common chargers for mobiles and all portable electronic devices. Subsequently, a detailed report is scheduled to be submitted in 2 months. Last week on Wednesday, the Department of Consumer Affairs met industry stakeholders regarding such a policy. After the meeting, Consumer Affairs Secretary Rohit Kumar Singh said that India could initially explore shifting to 2 types of chargers, including a C-type port. The ministry's move came days after a European Commission resolution that all smartphone makers would have to support USB-C as a single charging standard by 2024. This would apply to all mobile devices across EU nations. Under the new rule, European bloc consumers would no longer require different charging devices and cables every time they purchase a new mobile phone. Also, the European law would reportedly end the need for providing chargers with new phones and similar devices since users would already have the necessary accessories. Depending upon the contours of the Indian policy, you might have a similar experience. For Indian consumers, such ease of use and charging won't be limited just across different smartphones. This is indicated by the fact that separate expert groups will be set up to study charging ports used in 3 segments: mobiles and feature phones, wearable devices, and laptops and tablets. A one-charger policy is also likely to find wide public support. Chargers and charging cables from the original equipment manufacturer can be expensive. According to a local circle survey, 9 in 10 consumers want the government to standardize charging cables for smartphones and tablets. However, the India Cellular and Electronics Association has said that bringing in a common charger for mobile phones by migrating to only the USB Type-C port would raise the prices of low-end devices. While the price increase might not be too significant, the wafer-thin margins in that segment calls for consideration.
I would say a consumer-friendly step because right now people are with multiple devices, multiple gadgets, even on the go. A laptop and a smartphone is with many of the users out there. They take 2 devices together. Then we have now added like smartwatches there, or a TWS wearable is there. Now all these devices put together, although like for the wearables we use the same charger as the smartphone, but laptops in many cases is a different charger out there. So is the case for tablets. Now if all these devices are together and there is only one charger being used for across these devices, it is very convenient for users. There are already a couple of brands in the market who have a same charger. You can use it for the laptop as well as for their phones. That brings in a bit of convenience for sure.
As reported by Business Standard, various industry bodies have urged the Consumer Affairs Ministry to not implement the common charger policy until the European Union does the same. They want a closer examination of the regulation's feasibility and the lessons that will be learned from the EU before any action back home. Industry bodies also called for thorough market and consumer research. According to ICEA chairman Pankaj Mahindru, India is home to a large charger manufacturing base, which aspires to be a world leader in the sector. The policy could affect the promising industry with reduced domestic demand. Countries around the world possibly turning to common chargers could also impact their export potential. Experts believe that mandating only 2 types of chargers and a C-type port for all devices would impact tech giant Apple the most because it does not use a USB-C port for charging. Samsung, Xiaomi, Oppo, Vivo and Realme, which are the top 5 brands in the Indian market, use Type-C charging ports. Some entry-level smartphones and feature phones still use a micro USB cable.
Charger right now and battery as such is, one of the, I would say, key focus areas for all OEMs when I talk of smartphones. Because, application use cases like gaming has pushed, everyone to have fast charging, higher, battery out there. Now, that is where, all OEMs are right now trying to bring their USPs. Some are, crossing the limits. We have 100, 120 watt chargers. We also have 240, 250 watt chargers now going in smartphones being showcased by some of the OEMs. And they definitely want to take that, leverage that kind of R&D efforts they put. While on the other hand, there are certain OEMs who want to stay, I would say, maybe traditional in the outlook and want to stay with their thought process is a bit different, that probably consumers don't need that very fast, aggressive charging. So, that kind of flavor can only exist if OEMs are allowed to have a bit of, room to do their own R&D and have their own differentiation. With this kind of initiative, what's going to eventually happen is that there is all possibility that, then the charging as technology gets outsourced to a single or a few, players in the ecosystem who then supply this charger as a module to the OEMs. So when that kind of thing happens, okay, there will be segments and layers, I can understand that. But then, you don't have much room and you don't have much to differentiate.
To this end, the Ministry of Consumer Affairs is also considering the environmental angle. According to the United Nations University, India generated more than 3,000 kilotons of e-waste in 2019. Out of this, just 30 kilotons were formally collected. A one-charger policy could prove to be a small but not insignificant step towards addressing this challenge.
Standardized chargers may rid you of the clutter on your desk, but tech giant Apple believes it may stifle innovations to improve battery life of mobile devices. Meanwhile, your mobile devices are set to get smarter with 5G. But the US fears that using Chinese 5G technology will open a backdoor for Beijing spy agencies. Consequently, it has been actively pressing its allies to ban the Chinese company Huawei's equipment from their national networks. Now, Indian telcos have also shut out China's Huawei and ZTE from their 5G rollouts. Why are so many countries building a China-free wireless infrastructure? Let's find out in this segment.
The chiefs of the US and UK security agencies held an unprecedented press conference and issued a joint warning against China in early July this year. The heads of the FBI and MI5 alleged that China posed a long-term threat to economic and national security. China, for its part, called the accusations groundless. But the wind against China has been blowing for quite a while now. and accusations of cyber attacks and spying are also not new. China's biggest tech company, Huawei, has seen its 5G business prospects being blunted across the world, especially since the US has been actively pressing its allies to ban the company's equipment from their national 5G networks. India became more circumspect after the border clashes with China. It has joined a growing number of Western countries that have shut out China from 5G. In May, Canadian wireless carriers were barred by their government from using Huawei or ZTE equipment in their 5G networks. The US, Britain, Australia, and New Zealand, who are members of the Five Eyes Intelligence Sharing Alliance, along with Canada, had also previously banned Huawei from their respective 5G networks. This is the result of years of US lobbying with its allies. In fact, the US has gone so far as to warn them that it would reconsider intelligence sharing with any country that uses Huawei gear over fears of Chinese cyber espionage. In 2018, the Japanese government effectively banned Huawei and ZTE from official contracts. Sweden, too, banned Huawei and ZTE from its 5G network in 2020. In India, Chinese telecom gear makers were not permitted to participate in the 5G rollout. Given that the Chinese accounted for 20% of India's 4G gear market and Huawei's position as a global 5G leader, it is not a far-fetched idea that Chinese vendors could have cornered a sizable share of the gear market for the next generation networks. And now, Indian telecom companies have effectively shut out China's Huawei and ZTE from their 5G rollouts. In early August, Bharti Airtel signed agreements with telecom equipment majors Nokia, Ericsson, and Samsung to commence 5G services deployment across India. Reliance Jio, which had opted only for Samsung for 4G, was reported to be in talks with Ericsson and Nokia apart from Samsung. The company has already conducted 5G trials with Ericsson and Samsung. Jio is planning to offer 5G across 9 cities by January, most likely starting with Mumbai and Delhi later this year. Huawei and ZTE will also be phased out of Airtel's 4G network to be replaced by Ericsson, Nokia, and Samsung. Being barred from India translates into a considerable loss for Chinese firms, as Airtel alone has signed multi-year 5G equipment deals worth close to $2.5 billion. Analysis Mason, a TMT management consulting firm, recently told a Financial Daily that Jio, Airtel, and Vodafone Idea could spend anywhere between $18 billion to $22 billion over the next 5 years to upgrade and expand their networks to roll out 5G. Freezing out Chinese vendors will have an impact on Indian 5G networks because Huawei equipment tends to be less expensive than alternatives from Nokia and Ericsson.
Clearly, it will increase the cost of 5G rollout if these two companies are excluded. One, of course, has to appreciate the reasons, namely security reasons that have been cited. I think the impact will actually not be seen in the immediate future, but maybe slightly later. In the initial stages, 5G will be essentially used by enterprises and industry. And one can reasonably assume that those sections are less price sensitive than the average consumer is. So the ability of the telcos to pass on some of the costs to to the industry is that much more easy, which is something that may pose a bit of a challenge when you're talking about rolling out the service to a larger population. As we've always known, that if the cost of the operators goes up, whether it is through more expensive equipment or overpriced spectrum, the losers are eventually those users or those sections of the users community which are slightly more difficult to serve because they are not particularly commercially attractive.
However, India's government and telcos are willing to absorb this impact owing to security concerns. The Indian Army plans to use 5G services to enhance communication among its frontline troops. Industry 4.0 applications will also require 5G, which will be used for setting up captive private networks to enhance efficiency at critical infrastructure like seaports and airports. Overall, there is a scope for setting up more than 150 captive private wireless networks in India. However, Huawei has won 5G contracts in Russia, the Middle East, Africa and Asia, including the Philippines and Thailand. South Africa will also be using Huawei equipment. Brazil has said that it won't exclude Chinese firms from bidding for 5G contracts. Meanwhile, Norway has decided against a ban, leaving individual companies with the right to choose. Huawei also has a presence in Singapore. The battle lines have been drawn. However, the real question is this: can India really secure its interests, both military and geostrategic, when China continues to extend its lead in strategic communication and IT technologies?
Worries among the US lawmakers over the threat of espionage posed by Chinese telecom equipment can be traced back to a US government report in 2012. Back home, equity markets have impressively sustained their recovery for almost 2 months now. However, last week's gains were erased by Friday's sell-off. So can this recent strength extend into a sustainable long rally, or will it fizzle out? We find out in our next report.
In a sharp reversal from June lows, the frontline Sensex and Nifty indices have rallied around 16% each, after touching a 4-month high last week and reclaiming the 60,000 level. The Sensex pulled back by 650 points on Friday as investors exercised caution. The Nifty came close to 18,000 during the week but closed near 17,700. The recovery in the last few weeks has been led by a U-turn in foreign outflows and expectations of a slowdown in rate hike cycles amid declining commodity prices. However, analysts warn that any possible long-term rally will still witness bouts of volatility.
In the last 1 month, several factors supported the markets and helped markets to move up. For example, the rate of inflation, both in the US and in India, moderated. Though it was not substantial, there was some moderation. That gave some comfort to market participants that central banks could moderate their approach to rate hikes in the coming months. And there was kind of a sporadic buying in the equity markets by the FIIs. Though inflation rate has moderated, the central bank policies are not going to be that soft, mainly because of the fact that the moderation in inflation is quite limited. These things could bring in some amount of pressure on the markets, and that's something that we need to be careful about as we look ahead.
Sharing similar views, VK Vijay Kumar, Chief Investment Strategist at Geojit Financial Services, says the market momentum is likely to face some headwinds from now on. With the sudden sharp spike in the dollar index to 107.6 level, consistent FII buying may also lose steam. Some profit booking and diversion of money to fixed income may be considered as a short-term strategy. That said, going by technical charts, the benchmark indices look bullish over the medium term.
Indian indices have staged a smart recovery from their 52-week lows seen in June 2020. Both BSE Sensex and Nifty are up 18% and have not only crossed the 50% of the fall but has conquered 61.80 Fibonacci retracement. Technically, whenever any indices cross 50%, the trend is said to be bullish, and here both the indices have crossed 61.80, indicating a strong bullish momentum. In addition, the trendline breakout shown by the Sensex and Nifty, which one can draw and connect from the historic highs of October and to the subsequent highs seen in January and April, one could gauge market is trading well above that trend line. All these indicators are indicating fresh breakout and strong bullishness, a resilient sentiment that can drive Sensex to 65,000 and Nifty to 19,000 levels.
Today, markets will track global peers for an inflow trajectory and oil prices for direction. Besides, later in the week, airport service aggregator Dreamfolk Services' initial public offer will open for subscription on Wednesday.
The benchmark indices look bullish over the medium term. But what if you want to transfer your shareholdings to someone in the family instead of selling them? Sure, you can transfer those holdings, but that's not exactly same as transmission of shares. How are they different? Let's find out in this segment.
While the transfer of shares and transmission of shares suggest a change in ownership of the title, the former is voluntary and initiated by the transferee or the transferor, and the latter is operational by law and is initiated by legal representative or receiver. Transfer of shares is the intentional transfer of title of shares between two persons. The shares of a public company are freely transferable unless the company has a valid reason to disallow the same. The shares of a private limited company are not transferable subject to certain exceptions. A transfer deed is executed for the transfer of shares. Transmission of shares happens when the holder is no more or has become lunatic or insolvent. It can also take place when the holder of shares is a company and it has wound up. There is no transfer deed executed here, and the transferee will be given the rights to the shares, and the transmission is recorded only when the transferee gives proof of entitlement to the shares. In case of the death of the holder, the shares will be transferred to the legal representative, and in case of insolvency, to the official assignee. Form SH4 has to be duly stamped, dated, and is executed by or on behalf of the transferor and the transferee, and specifies all the details like name, address, occupation, if any, of the transferee. It has to be delivered to the company by either parties within 60 days from the date of execution, along with a certificate of securities or letter of allotment of securities as available. If the transferor makes an application for the transfer of partly paid shares, then the company gives notice of the application form SH5 to the transferee, and the transferee must give no objection to the transfer within 2 weeks from the receipt of the notice. The documents for transmission of shares include certified copy of death certificate, self-attested copy of PAN, succession certificate, probate of will, letter of administration, court decree, specimen signature of successor, etc. Every company must deliver the certificates of all securities transferred or transmitted within a month from the date of receipt of the instrument of transfer, in case of transfer or intimation of transmission as applicable, unless prohibited by any provision of law or any order of court, tribunal, or other authority.
I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.